Alright, today we're going to decode what I like to call the secret language of the market, Japanese candlesticks, and I want you to forget about seeing them as just these complex, intimidating charts. Instead, think of them as the visual language of market psychology, a story of fear, greed, and indecision, all told in simple shapes and colors. You know, every single shape, every wick, and every colored bar on here tells a chapter in this constant battle between buyers and sellers. By the end of this, I promise you won't just see a chart anymore. You'll actually be able to read the story the market is trying to tell you. So here's our game plan. We're going to start with the absolute basics, the single building block, one candle from there. We'll look at bullish and bearish signals, uncover those moments of market indecision, and then we'll wrap up with what is, without a doubt, the most important rule of all: why context is king. Okay, let's dive right in. Look, before you can read the whole story, you gotta learn the alphabet, right? Well, for price charts, that alphabet begins with understanding one single candlestick. If you can master this, everything else will just fall into place. So, what exactly is a Japanese candlestick? Well, think of each candle as a complete story of a single trading session. Doesn't matter if it's 1 minute, 1 day, or a whole week, it packs 4 absolutely essential pieces of information: the price when it opened, the absolute high and low points it hit, and where it finally closed. And here's the really cool part: with just a single glance, the color tells you who won that session's battle. If it's green, the bulls, the buyers pushed the price up and came out on top. If it's red, the bears, the sellers dragged it down and took control. It's really that simple now. Every candle has 2 main parts. You've got the thick part, that's the body, and it shows you the core battleground between the open and close price. A big, long body means one side won, and they won decisively. Then you have the thin lines, the wicks. They show the extremes of the fight. Think of a long wick as the market testing a price level and getting slapped right back down. Okay, so now that you get what one single candle's all about, let's see how they combine to form patterns. We'll start with the good stuff, the bullish signals. These are the clues that suggest buyers are starting to really take control of the market. And first up, we've got a classic pattern. The hammer, its shape is pretty unmistakable, just like its name suggests. And when you see it after a price decline, it can signal a major turning point, like the market is literally hammering out a bottom. So here's the story the hammer is telling you. The sellers try their best to keep pushing the price down. That's what that long lower wick represents. But they failed. The buyers stormed in with so much force that they drove the price all the way back up. It's a textbook signal that the sellers are getting exhausted. Next up is a really powerful 2-candle pattern, the bullish engulfing now. This isn't just a small shift in momentum. We're talking about this pattern can signify a potential tidal wave of buying pressure coming into the market. What makes this pattern so incredibly significant is how that second green candle completely overtakes or, engulfs the previous day's red candle. It's like a visual knockout punch, showing a really sudden and decisive shift from selling to buying. All right, so just as there are signals for a potential rally, there are also patterns that act as warning signs, telling us a price climb might be running out of gas. These are the bearish signals, and they show up when sellers are starting to win the fight. The bearish cousin of the hammer is the shooting star. It has a pretty similar shape, just flipped upside down. But the key here is its location. It appears at the top of an uptrend, and it can signal a potential peak in the price. The story here is really one of overconfidence. The buyers try to push the price even higher and higher. That's what creates that long upper wick. But they reach just a little too far, and the sellers step in and forcefully slam those higher prices right back down. It's a huge warning sign that the buyers might be losing their grip. And yep, you guessed it, just like its bullish counterpart. The bearish, engulfing pattern is a powerful two-candle warning. This time, though, it signals that the sellers are coming out in full force, ready to take over the market. This pattern shows a super dramatic reversal. The buying momentum you saw in that first little green candle, that doesn't just stop, it gets completely overwhelmed and erased by the sellers. In the second candle, it's a very clear signal that the market sentiment has flipped and sellers have seized control. So, sometimes the market isn't clearly bullish or bearish. Sometimes it's just confused. There's this intense tug of war going on, where neither side can get the upper hand. And these indecision candles show us that the market is just taking a moment to pause and think, and this little guy is the doji, because the open and close prices are almost exactly the same. Its body is just a tiny thin line. It represents a perfect stalemate, a moment of equilibrium, where a fierce battle between buyers and sellers just ended in a flat-out tie for the session. But here's the thing, not all stalemates are created equal. These two variations, the dragonfly and the gravestone, actually tell us who is losing strength. The T-shaped dragonfly shows that sellers tried to push prices down but failed. The upside-down gravestone tells the opposite story. Buyers tried to push prices up and were defeated. Both signal indecision, but with a huge clue about who's running out of steam. Okay, everybody, listen up, because this is probably the single most important lesson we're going to cover seriously. Memorizing patterns is easy, but understanding where they matter, that's the real skill. A pattern is only as good as where you find it. You have to remember this. Candlesticks are not a crystal ball. They are a tool for judging probabilities. A perfect-looking hammer pattern that just pops up in a random part of the chart. That's usually just noise. Its true power, its real meaning comes from its location. So this brings us to a super simple but incredibly powerful three-step framework. First, you identify the pattern. Second, and this is the absolute key, you check its location. Is it happening at a price level where the market has reversed before, like a key support or resistance zone? That's where these signals become super reliable. And finally, you wait for the next candle to confirm that the story is actually playing out. So let's bring it all home. What have we learned? Well, every single candle tells a story about the market. Psychology. Bullish patterns show buyers are taking over. Bearish patterns show sellers are getting the upper hand. And dojis show indecision. But the biggest thing I want you to walk away with is this: a pattern alone is just a hint. A pattern at a key location with confirmation. Well, that's a powerful high probability signal. So from now on, when you pull up a price chart, don't just see a bunch of lines and colors. Ask yourself, who's in control right now? Who's losing steam? What is the story that the market is telling you right now? That right there is the key to decoding the language of the market.